Well, thank you. Firstly, thank you very much for inviting me on the webinar. It's always great fun to be on these things, and no, no entrance to any webinar will be complete without a last-minute drama with technology. And unfortunately, I had it with my confounded Mac. So there you have it. And thanks for your patience, by the way. So as Simon said, today we're going to discuss about how you can trade the news effortlessly. My name's Robert Colville, and I'm head of thelazytrader.com, which I founded back in 2012. And do stay tuned. In this webinar, we'll be giving away prizes in the form of mentoring, access to events, and things like that. So it's in your interests to not fall asleep. I'll try my best to keep it as lively as possible for you. So for those of you who don't know me, I'm Rob, and I founded The Lazy Trader back in 2012. I've been accredited by the Society of Technical Analysts. I always struggle saying that word. But I haven't always been a trader. I mean, I started my journey in the currency market, the stock market, in 2007. I used to be a journalist back in the day. I just graduated from university. I moved up to London, did a Dick Whittington to come and seek my fortune, but unfortunately my graduation coincided with the credit crunch. So no one was hiring, and those people who were, well, you can be rest assured they were paying pretty derisory sums of money every week. So I was really struggling. So I was looking around at various options to make the extra keep the extra golden guineas rolling in. One was network marketing, which I was pretty fabulously dreadful at. One was being a recruitment consultant, which again, I wasn't that good at. I didn't really like it. And then I fell into trading. And you can be sure of one thing, I didn't take to trading naturally. I was pretty arrogant with it. I made every single mistake in the book several times over, many times over, in fact. And it was a humbling experience. I started off very arrogant in the markets, and it was a very, very humbling experience where the market was my best mentor, ultimately. I chose the hard route, but ever since becoming consistent and deviating towards a strategy or gravitating towards a strategy, I've since been helping people since the inception of the Lazy Trader brand, and we focus on FX, stocks, commodities, and we've taught thousands of people around the world, whether it's London, Singapore, South Africa, you name it. So end of day trading, or end of week trading as we now call it, really is the sweet spot, like I mentioned to Simon just now, where you can have your money working for you, and you can be rest assured that you have it plugging away in the background, trading a profitable strategy while you go about your daily life doing the more interesting things, quite frankly, whether it's working for a guaranteed salary in a profession you enjoy, or even if you don't enjoy it, you can be rest assured your money's still working overtime for you. The great thing about trading for me is it allows me to essentially entertain hobbies and interests. Tennis, I do a bit of mentoring for the Prince's Trust. So that's about me. But anyway, you didn't take time out of your busy lives to hear me prattling on about myself all day, so let's get on. All right, I just want to basically reassure you, for those of you who don't know me or us, we're a brand you can trust. Our mentors have all been accredited by the Society of Technical Analysts. We've got a good rating from the Forex Peace Army, 4.5 out of 5, and we've just been accredited, our courses have all been accredited by the CPD. So make of that what you will. Okay, so let's get on to the crux of today, news trading and how you can trade it, and let's get on. Okay, so just keep a look on the disclaimer, nothing untoward there. If you've got any questions, please feel free to add them in the chat window. Okay, so first and foremost, a lot of people are surprised to hear that despite trading the news profitably, most of their success is actually down to not really caring what the news is and or when it's released. Okay, there's a certain style of trading we entertain which basically ensures that we can get it right and we can make a lot of money, but if we get it wrong, we only are set to lose a small amount of money, and that's thanks to risk sizing. Okay, so the great reason why we don't worry about news is because we cannot predict the news. Some people get it right some of the time. Nobody gets it right all the time. Okay. The fact is that if we're not worrying about news, it helps our trading become far more of a peaceful and relaxing hobby. And if we were worrying about news every day, quite frankly, we would never leave the screen. And we'll always be mollycoddling our trades. And we don't want to do that. We just want to set our trades up, walk away, and just be safe in the knowledge our money is working overtime on our behalf on autopilot whilst we're doing something else. It's called smashing the time money link or breaking the time money link. And that, for me, is the nirvana. So we select trades with a very high reward to risk profile, and that will essentially carry us all the way. Okay, we trade the daily and the weekly time frame. It's no coincidence. Not only does it require less maintenance in terms of the selection, if we trade the daily time frame, we only look out for opportunities once a day. And when we trade the weekly time frame, guess how many times is required to identify opportunities on the weekly? You may have guessed it. We only need to go through the charts once a week if we're trading the weekly bars. And this is what we're increasingly doing, so that, again, we can go out and do other things in life which are slightly more interesting than watching a load of bars on the chart moving around and listening to see what Bernanke has got to say, or Carney. You know, who cares? According to my humble opinion, that is. Okay, so the great thing about the daily and the weekly is they have far greater market structure. This enables us to have our entry and our stop loss at tactical points. It takes far more money and volatility to move those markets in bigger directions. Okay, so essentially we can just set our trades up, be triggered in, and just wait for the end of the day to get our verdict, or the end of the week, or even the end of the month. All right. So the market structure in the daily and the weekly chart is far better established than if we're trading the relatively noisy 15-minute chart or hourly chart. So we are 80% technical analysts, 20% fundamental. And when I say fundamental, I'm referring to looking to see if our trade has positive or negative carry. We look for general themes, but that is not for the purpose of this webinar. Okay, we're just going to talk to you about the concept of trading the news, ironically, without knowing what the news is or even caring what the news is. When people say to me, "Oh, Rob, it's non-farm payroll today, what do I do?" My simple response is, "Oh, really? Is it? I didn't even know." I don't keep an eye on the watch with these things. But of course, we do keep an eye open, or half an eye open, for events, for example, like elections and referendums, like Brexit, the Scottish referendum. Who knows, we might even get another referendum as to whether we want to ratify the terms of the Brexit deal. We'll see. Some people actually say we might not even leave the EU, but that's yet to be seen. Okay, so trying to predict the news is essentially a mug's game. Okay, we have no crystal ball. We have no kind of like consistently reliable snitches inside these central banks or inside central governments. And even if we did, they'll be breaking the law and they'll be put in jail if they're leaking news to us traders on the outside. Okay, so like I said to you just now, some people get it right some of the time through crunching the data. Some people get it right most of the time, but nobody gets it right the whole time. So what we simply do, like I'll show you in a minute, and I'll show you some examples of trades we've taken based on news, and obviously it will be rude not to tell you about the current trades we're in at the moment, so you can get a real snapshot as to how we trade. So when we're looking at the charts, we look for a setup with high reward to risk, and we are of the notion that if we get it right, then we are very right and rewarded handsomely if the news happens to go in our direction. And if we're wrong, we lose a small amount. All right. Remember, if news goes in our favor or not, the favor of our trade, it's 50-50. All right. But if, say, for example, the 50% chance we're right and we've got a trade set up which could make us a 3% return on our trading account, then we can potentially make 3%. It helps to perpetuate a winning trade far quicker. So we've made 3%, best case scenario. But if we're wrong and we risk only 1% of the trade, of our trading account on the trade, then we stand to lose only 1%. Worst case scenario, maybe a bit of slippage as well if the market is fast moving. But if you think of it, this analogy, it's like flipping a coin. If you've got, say, heads and tails, and you're flipping this coin, and you know, hey, it's 50-50, it can land on heads or tails, But if you're right, you could make £300 or $300, and if you're wrong, you can lose 100. Then you'll keep on flipping that coin, because it's very much the odds steeps in your favor for when you're right. You win handsomely. If you're wrong, you lose a smaller amount, relatively speaking. Okay, so this is why we trade setups of high profit potential, and we trade size. Okay, it's very important, as Simon already mentioned. Trade sizing and risk management are key to keeping your trading business in trim order. Okay, so we say to clients, never risk more than 1% of your trading account, whether you've got a $1,000 trading account or £1,000 trading account, £100,000 or £500,000, or even 100. Even if you've got a smaller trading account, trade sizing is as crucial. I know it's tempting to try and risk more if you've got, say, £100, £200 account, because of course it's small money, but these bad habits then become further ingrained into your trading psyche, and we don't want to do that. We want to get into good habits early, and that's absolutely crucial. There's no such thing as a perfect setup which works. Even the best looking trades can sometimes bite the dust and go completely wrong. This is why risk management is so important. Okay, but when we do trade a setup, like I mentioned to you just now, we risk 1%. We say to clients, risk no more than 1%. If you're 6 months profitable or consistent, should I say, then risk 2%. We risk 2%, but no more than that. So if we're targeting a 3-to-1, risking 2%, then it's likely if we hit target, we'll make 6% return. Okay, but with this kind of high profit potential, or finding trades of high profit potential, it's very important to remember that the higher the profit potential, the lower the probability is in terms of hitting targets. A lot of people make the mistake of kind of going beyond what is within the realms of possibility when they're targeting their trades. It's all too tempting to look at a setup and say, hey, okay, here's the evidence for the market potentially going up tomorrow. Say, for example, GBP versus the US dollar, cable. Let's target a 10-to-1. Of course, that's all very nice on paper, but is it really going to happen? Not unless the chart tells us. Okay, and I'm going to talk to you about a setup at the moment which we're in for the British pound versus the US dollar, which is actually quite nice. Reversal traders out there, keep your eyes open. So that is essentially it. So I know those of you who come to these webinars routinely, then you'll probably know about reward to risk. Establishing a reward to risk, here's the formula. If you've got a smartphone with you, by all means, take a picture of this screen. I think these webinars will also be made available afterwards. Someone will make them available. But in order to establish the reward to risk profile, remember that we like to go for 2-to-1 and above, 3-to-1 preferably. Then what we look to do is divide the entry price, take away target price, divided by our entry price, take away stop price. So say, for example, we have 178 pips potential profit if we're trading a setup, and we're risking 45 pips. We divide the 178 pips by 45 to reveal 3.9-to-1. Now, if we look at the setup and we say, hey, okay, we've got a big news announcement tomorrow, it's non-farm payroll day. Well, we can say to ourselves, well, hey, that's all very well and good, but if, for example, non-farm payroll happens to be in favor of our trade, then we could potentially make £390 if we're trading 1% of, say, a £10,000 account, or 3.9% if we're right, and we can only lose 1% if we're wrong. Worst case scenario, maybe some slippage as well we'll lose. But it's a valid proposition, okay? 50-50, say non-farm payroll going in our favor or not. If we're right, we make 3.9%. If we're wrong, we lose 1%. How about that? That's how bull-minded we are when it comes to trading into news announcements. I can guarantee you, when you're looking at the charts and doing backtesting of any strategy, if you've got an automatic backtesting software or you're doing it with your own kind of eyes, I can be rest assured that you will not be factoring news into the equation when you're looking at historical data on the chart. Okay, if you're looking at news as well, every news announcement and its influence on every day, every bar, then you'll be there forever crunching data. And frankly, we haven't got the time. Life is too short, and it will get you into the zone of analysis paralysis. Okay, so let's just look at this. Forgive the different color bars, blue and white. So we had a slight problem with importing these charts into PowerPoint, and I've got this new computer. It's an iMac. I've finally made the move from a PC, and for some reason it's not getting onto my software programs. But anyway, as long as you can still see it, that's the main thing. So say, for example, here we're in a downward trend. We're looking to sell the rally in a downward trend, and this is a turning point punctuated by a bearish pin bar reversal, a bit like what we're trading on the daily with cable at the moment, okay, as of the close of day before yesterday, Wednesday's bar. So, sorry, not Wednesday's bar, Tuesday's bar. Anyway, looking at this, we've got a potential signal to sell. We've got a distance of 160 pips difference between our entry price and our stop loss, and we've got to the next swing low, or just below the previous swing low, this target of 575 pips. So what we do is we divide 575 by 167. We divide our profit potential, our reward, by our risk to come at a figure. And in this case, it's 3.4 to 1. So if, say, for example, we've got a £5,000 trading account, or we're risking 1%, which is, of course, £50, $50, whatever currency denomination you got it in, is fine. But we know that if we're right, we could potentially make £170. If we're wrong, we lose 50. Would you take it? Regardless of what news announcement there is the next day, tomorrow, the next day? I certainly would. It's a valid, worthwhile proposition. Let's take a look here. Another downward trend. Sell the rally in a downward trend. We've got a complex retracement and the turning point punctuated by, yet again, a bearish pin bar reversal. The distance between our entry price and our stop loss, which is the break of the low, our entry is the break of the low and our stop loss is above the high. We've got 86 pips difference there, but our target is the previous swing low, and we've got 245 pips potential reward. So with a £10,000 trading account, we risk 1%, which is of course £100, and we know, okay, 245 pips reward divided by 86 is 2.8 to 1, which means that if we're right, okay, we can expect £280 return, and if we're wrong, we only lose £100. Okay, so you can see what I mean here. All right, so let's talk about how we can actually put this in motion. Okay, pin bar reversal strategy. I'm going to talk to you about timing, selection, and management. I'm going to show you a few kind of like examples at the moment. Okay, so for those of you who aren't familiar with the term pin bar reversals, they're essentially a sign to us that a price in the market has been rejected, and that if it's a bullish pin bar reversal, we've got the open and close in the top third of the bar, ideally the top third. Sometimes it can be in the top half, and they could take on any color, but essentially they're a bar of a tail, and it's a clue that the market could potentially go up the next period of time, whether it's the daily, the next day it could go up, the next week if it's the weekly chart, it could go up the next week. Conversely, if it's a bearish pin bar reversal, we look out for, again, a tail with the open and close in the bottom third, preferably, or the bottom half of the bar. And it's a sign that price has rejected a certain price, but the bears have come in to bring it back down again. And it's a clue to us that price is going to go down the next period of time. So if it's a bearish pin bar reversal on the daily chart, it's a clue that price is likely to go down the next day or the next week if it's the weekly bar. So what we look for as well is, this is one of our tails as well, is if this bearish pin bar reversal or bullish pin bar reversal is underpinned with a reversal on the smaller time frame. So if we've got, say, a bullish pin bar reversal with the open and close in the top third, and if we scroll down to the hourly, it's got a W-shaped formation with the higher low, or indeed an inverse head and shoulders, then that's a sign to us that we've got time frame correlation. Okay, we've got the higher time traders and the smaller time frame traders essentially agreeing on the same thing, and that's extremely powerful for those people who trade pin bar reversals. Some of you might know them as morning or evening stars or low or high test bars. So just to recap, we go back to this page here. we want to look for a bullish pin bar reversal with a bullish reversal pattern on the smaller time frame. So say if we're trading the daily time frame with our bullish pin bar reversal, we'll want a bullish reversal pattern on the hourly time frame. If we're trading, say, a bullish pin bar reversal on the weekly time frame, then would want a bullish reversal pattern, whether it's a W-shaped double bottom or an inverse head and shoulders on the 4 hourly time frame. Okay. On the flip side of the coin, we've got also this here, the bearish pin bar reversal. We have, like I mentioned to you, the open and close in the bottom third. That's bearish. Of course, it's a clue to us that we could potentially see a downward move the next day or the next week, depending on whether we're looking at the weekly or the daily. But we want the smaller time frames to essentially agree. Time frame correlation, like I mentioned. So we'd want a bearish reversal pattern on the 4 hourly, whether that's punctuated by a double top with that all-important lower high, or indeed a head and shoulders pattern. Either are equally as valid, and it's a sign to us that the shorter term and longer term time frame traders are singing from the same hymn sheet. Okay, so that is an important tell. How you use that is entirely up to you, but I just want to show you that if we are entering like a bullish pin bar reversal for a long, then our entry will just be above the high, stop loss will be just below the low, whereas if we're entering a bearish pin bar reversal, our stop loss will be just below the low. Sorry, our entry will just be below the low. I repeat, our entry will be just below the low, where our stop loss will be above the high. Makes perfect sense, doesn't it? But one thing, if you're trading the daily time frame, as most of the transactions for foreign exchange take place in Europe, it makes sense to look at European time. So we really just look to trade the daily time frame after or around 10 p.m. BST or GMT, essentially, when we've got the Europe, when things are going to sleep in Europe. Okay, because not very many transactions are happening in Australasia or Asia, comparatively speaking, and not that many, comparatively speaking, in the Americas. So most of the action happens in Europe. So you'll typically notice, those of you who are night owls, markets don't really do much overnight unless we've got news or in Japan or Australia or New Zealand, or there's some kind of end of the world events. So this is why we look at the 10 p.m. close that coincides with the New York close as well. Incidentally, the stock market's in New York, and typically the markets do quieten down. This is where we get the close of the daily bar. So we have, say for example, a conclusive close of a bullish or bearish pin bar reversal. There's no point looking at the daily chart for a potential bullish or bearish pin bar reversal in the middle of the day, because what might look as a bullish pin bar reversal, say at lunchtime, could close 10 hours later as just a regular bar. So that's another reason why it's good not to look at the charts in the daytime. They're like being in a casino to some people, myself included in my formative years. You see the flashing, flickering lights on the broker platform, you look at the moving bars on the charts, and you're almost kind of like seduced in, and the longer you look at the charts and the movements, the more you feel like you've seen a setup. This is why, if you're starting out, or even if you're more of a seasoned professional, it's those quieter hours where you can really get clarity. When you're trading the weekly time frame, and I encourage you to do this, it's very much an underrated time frame. Doing it on the weekend, nothing gives me more pleasure than to actually just do my market analysis on a Saturday morning with a coffee in hand somewhere in London, in the centre of London. So knowing that the markets are closed, I can do my analysis, and it's all very peaceful and relaxing. And that's exactly what I do. And you should too, if you want to. Okay. So for a trend-based strategy, we talked about the entry and entering these bullish or bearish pin bar reversals, but how about trailing if, as and when you're in the position? Well, what we do is we trail for every second buyer bar, because on one hand, you want to accept that, okay, we want to offset risk and lock in profit along the way, but we do not want to be too aggressive in our manner of doing this, because if we're too aggressive and trail for every kind of pip we make profit, then you'll find that you'll make a tiny profit, you'll be stopped out, and to your horror, you'll see the market going completely in your direction. And you don't want that to happen. It really is a common kind of mistake people make, okay? They might make a few losses, And then what they do is whenever they come to their winning trades, they'll simply close it as soon as they possibly can. And that's when they leave the money on the table, essentially, because typically, sod's law, that move will go to the moon and back, and you don't want that to happen. You want to be in that position. Okay, so the 2-bar trading technique is important. It also takes into consideration that the market might move a little bit against you. It might retrace before going more in your favor if it is a winning trade. And if we're selling, of course, we're looking as well at locking profit along the way, and we'll be doing this with our current trade which we're in, and that's with the British pound versus the US dollar. And if you wanted to be aggressive but also kind of like mechanical with it, the 2-bar trading technique is quite powerful. Some of our clients prefer to go for the all or nothing technique, and that's just moving their stop loss to break even as soon as they've made the equivalent number of pips profit as they've risked, and then just leave it for either a break-even outcome or hitting at least their first target before they scale out. Okay, but that's moving on to slightly more kind of like advanced stuff. All right, so let's talk about some news announcements or themes that really have we've been aware of, and they've helped to perpetuate trade outcomes. Let's talk about the Scottish referendum. I'm just going to go to our charting package, eSignal. Hopefully you can still see my screen. Okay, so let's go back to the FTSE. There we are. So those of you who remember back in 2000, I know this is a long time ago, but it's still very relevant. We can see here, let's go to the daily, my apologies. And let's get the date as well when the Scottish referendum happened, 18th of September 2014. Okay, so let's do this. Okay, so what happened was in 2014, I remember this very clearly, we had the penultimate all-time high, which was here, this level here, and we had great fun just simply selling the bounces on this level. So I haven't drawn this level here. I need to draw that back in. Again, it's down to the changing of computers. It's all been very complicated. But yeah, we were having great fun when we were simply just selling the bounce on these levels of resistance, giving enough room to breathe. So this was throughout 2014. The FTSE was kind of like range bound. So we did this throughout May, June, July, through the summer as well. But September time came, and it was around about here. The Scottish referendum, we had a bearish pin bar reversal right here. So what we did was we simply traded the break of the low, which is what anyone trading a reversal, selling the top of the range, should do. Basically, it makes sense in a well-established range to simply sell the top of a well-established range and or to buy the bottom. So we just simply sold the break of the low, stop loss above the high, because we can console ourselves with the fact that, hey, this bar high tested, and quite frankly, it's very unlikely that price, given the high test and that whiplash rejection that they had, or price had at this level, it's unlikely that it's going to come up here again. So entry was a break of the low, stop loss above the high. And remember, the Scottish referendum was going to happen any time now. And obviously, given that markets like predictability, we knew full well that, hey, if Scotland did vote for their independence and broke the 300-year union, which we've enjoyed, everyone's enjoyed apparently, then markets would like that. The FTSE will plummet, and so would the British pound versus pretty much every other currency. But we knew that, okay, if the Scots did vote for the continuation of the status quo, then markets will either do nothing or rally. Now, the Scots voted against independence from the Union, or to break away from the Union, but we didn't get that rally. As you can see here, on the 18th, I think it was the 18th, right about here, it rallied up a little bit, a tiny bit, and then it plummeted. So you can see that those people who went for the all or nothing outcome, i.e. just entered at the break of the low and just left it, would have been rewarded or paid dividends. those people who tried the 2-bar technique would have scratched a little bit of profit out of it. This is why I'm more in favor of the all or nothing outcome if we're trading at these key turning points. You can see how much profit potential is on the table at this price extremity, the penultimate all-time high of the FTSE seen in 2014. You can see our entry here, stop loss above here, how many times it fits into this vast space here. Obviously, we had no idea it was going to go this far down, but we saw that, okay, in a nice scenario, we would at least sit and come to the midpoint here, preceding these levels. All right, so those people, clients at the time, would have had something running on this, whether it's a half position by the time after scaling out at the midpoints. So that's the Scottish referendum. Now I'm going to talk to you about Brexit, as this is something which I'm pretty sure all of you are quite sick of this, tired of people talking about, but you know, it's pertinent and it's very relevant. So this is a long time ago. Okay, this is a range with the British pound versus the Swiss franc. This range has been going on since 2011, and we can see even from say 2011 to December 2015. We can see here that we've done nothing but range in these price extremities. So any trader who trades, say, supply and demand or reversals will simply see this as an opportunity to sell the top of this well-established range here. Okay, British pound versus the Swiss franc. So what I did, I remember this quite clearly, I was absolutely exhausted driving home from London to Cornwall to stay with the parents. I'd only just caught this at the last moment. This was a bearish pin bar reversal, rejection, lower high of this level, which is held for, at the time, about 6-7 years. So it made sense to trade the break of the low here, stop loss above the high, and just leave it, anticipating that this would be the acceleration point inside a double top reversal. And these kind of setups are fantastic because you can get inside really at an efficient price point. You can get inside potentially a volatile move with decent reward to risk, with a stop at a safe place, with high reward to risk. Okay, so if you consider this here, remember, entry here, just below the low, stop loss above the high, and just feast your eyes on the bottom of this range all the way down here. Let me try and, there we are. So tiny little bar all the way down here. Okay, so we positioned ourselves early. This was 6 months before Brexit, and we were, you know, the market smart on us. We were heavily in profit very quickly, and we stayed in this trade. I decided to keep it as an all or nothing trade and move my stop loss to break even, and of course scaled out of the position. But with ranges this big, we can see that actually trends can occur. So let's fast forward, because we can see that it was likely that price is going to go all the way to the bottom of the range, given it has done several times before. So what we wanted to do was add to the position, and we did. We had several opportunities to add to the position. So remember, we are still in this position here, having scaled out a little bit. And now what we can do is, given that the British pound versus the Swiss franc, we're making lower highs and lower lows, we could have our entry just below the low of this bearish pin bar reversal, stop loss above the high, first target the previous swing low, and there we have it. We're in this trade. So our clients hit profit target, and then until Brexit, the referendum, we were just simply selling rallies in this downward trending market. It's a very, very straightforward way of making money. Remember, we're still in the position here. We entered here and here as well. So we took about 1, 2, 3, 4, 5 trades overall before Brexit. We took profit close out of some of them, but we still had this thorny issue of Brexit. What way is it going to go? Okay, opinion polls, leave versus kind of remain, were very kind of like up and down, and nobody really knew ultimately. But we knew, hey, if we did get Brexit and we left the EU, the British pound would plummet against the Swiss franc. If we remained, the market would either go relatively unchanged, given that that's what markets expected, Britain to remain in the Union, the EU, or the British pound would rally against all currencies and the FTSE would rally as well. But Nigel Farage ended up smoking a cigar and we voted to leave. There we have it. So we knew, we're already in this position, and we knew that, hey, if we're right and we did leave the EU, then we'd be proven very, very right, and our profits would be accelerated. And if we're wrong and the Brits decided that they wanted to remain, then at least we made something on the trade. It doesn't really matter, okay, because we're in it way earlier. So what I'm trying to say here, really to sum this up, is we essentially trade news, we treat news as a catalyst to these pre-existing positions we're already in. We see it as just a catalyst to help us decide whether the trade is going to be a winning outcome or a losing outcome far faster. And that's important, okay, rather than just simply dropping what we're doing and watching every tick throughout the news announcement and just kind of like micromanaging our trades, okay? Well, I don't have time for that. If you have a job or career, I'm pretty sure you don't either. This is why we just use it as a catalyst. We use news to take our advantage, to help perpetuate a winning trade in its crusade to netting us good rewards or good returns, or at least determining a negative outcome for the trade and a small loss. Either way, it's a quick outcome. This is why I call it a catalyst. All right. So, Simon, how are we doing for time?
Rob, we're fine. We've got about 15, 20 minutes.
Okay. No worries. I just wondered. I can't see why I watch here. That's good. Okay, we've got plenty to talk about still.
We do. Thank you. I'll give you a warning if it looks as if we're in danger of going over, but we'll come and maybe do some questions in about 10 or 15 minutes, if that's okay.
Yeah, sure. Are you okay for us to go up to the hour?
Well, just maybe until about 5:02.
No problem. Okay.
Thank you.
Oh, thank you, Simon. Okay, so that is essentially the crux of it, and we just use news as a catalyst. Okay, and I just want to talk to you about, so I've given you two examples here of like positions with kind of extreme news announcements. I thought I'll give you like extreme examples, but I'm just going to talk to you about some positions in which we're in and how you can benefit next time round. So we're currently selling the British pound versus the US dollar. I think it makes sense to talk to you about trades we're currently in, because it's always very easy to talk about hindsight examples of something that happened a couple of years ago or last decade. But quite frankly, the more exposure people have to the present, the current and now, the better it is. Okay, so the British pound has been kind of like retracing. I say kind of, I mean it's been making a very clear, complex retracements up to this point. And Tuesday essentially closed as a bearish pin bar reversal of the top point of this retracement, this channel, this bullish channel. Sorry, it's bearish channel, bullish channel. What am I talking about? Bullish channel in a bear market. There we go. If we look on the weekly time frame, just to give you a bit of context, we are making clear lower highs and lower lows. There we go. Lower highs and lower lows. You've still got that confirmation with the moving averages. We look for the 20, the 50, and the 200 as our objective measures as to whether the market is essentially going up or going down. Okay, so we still got that. It's confirmed on the weekly. The further the market falls, typically the longer the retracements are going to take. Okay, this is the longest retracement we've had, lasting about, well, dare I say, about 10 months? No, sorry, 8 months. But still, all good things must come to an end. And we found that this, a few days ago, we found that this bearish pin bar reversal here not only intersected with the downward trend on the weekly, but it also intersected with the top point of this retracement, this phase 2 retracement. Okay, and we had the perfect intersection. What is more, I'm just going to go back here. There we have it. We had our clues. We had bearish reversal divergence on the RSI. On one hand, price is making higher highs, but on the other hand, we've got lower highs on the stochastic. You can see that price has made a higher high here, with the current swing high just gone compared to the swing high towards the end of June. Price has made a higher high, whereas the indicators made a lower high. And that is a sign to us that the bears are creeping into the market. So what we did was essentially sold the break of the low, stop loss above the high, and we're targeting the previous swing low here, target 1, target 2, this swing low, target 3. We'll just be scaling out the positions. So yesterday we had an inside bearish bar, which is fine, and today we've had a bearish bar. So we're in the trade at the moment, up about 0.75%, and we're just going to ride this one out. If today happens to close as a bullish pin bar reversal, we'll kill the trade, because we do not like that. It's a clear warning sign that our trade's not going to go the right way. If we're trading the break of the low of a bearish pin bar reversal, and that's followed by a bullish pin bar reversal, then we know that the sell signal has failed. Okay, so we take our stop loss to the break of the high of the bullish pin bar reversal if that forms. But for now, it's looking great. Water's lovely, and it's warm, and it's, you know, the trade's going perfectly. Let's talk about the other trade we're in. We're in US dollar versus the Japanese yen, and we got into this trade a few weeks ago. Actually, we're trading this in a weekly time frame. We're benefiting from positive carry, because in America the interest rates are, I think, 1.25%, whereas in Japan they're nothing. So we traded the break of the high of this higher low. You can see here that with the US dollar versus the Japanese yen, we're in this upward trend here. We've seen this steep retracement. It's a 50% retracement. Fibonacci retracement from the move up, 50% retracement, then up, then retracement. But what we saw here a few weeks ago was a higher low. And these are always fun to trade. It's essentially an opportunity to take advantage of acceleration in what could potentially be the breakout from a bullish flag here, a bull flag. There you go, you can see it here. So we traded the break of the high, stop loss below the low, and we enjoyed the ride up to target 1, which is the previous swing high. And we scaled out the position at this point here, just this point here, and we sold half our position. We've got half the position still running. Our stop loss is at break even now, and we're anticipating price continuing to break this point here and to break out, reach this swing high. I know there'll be a bit of resistance here. So if it breaks its previous swing high, then fantastic. We're almost out of the woods, and we'll look to anticipate price to come up to this point here. So we're really hanging on. This is why I'm so passionate about the all or nothing trade outcomes rather than the 2-bar trail. Okay, the 2-bar trading technique is great if you want high probability, kind of small gains, but essentially when you're trading setups of high profit potential, it makes sense to give the market that extra wiggle room and space to move against you momentarily, relatively speaking, before it ultimately goes more in your favor. Okay, so had we done the 2-bar trail, we would just have moved our stop loss at this point here. We wouldn't have scaled out necessarily, but you know, we'd have nothing to write home about as well. So if this week closes a bullish pin bar reversal, we might even seek to add to the position. But ultimately, I'd want to see a breakout of this level before we do that. So that's actually quite important. So let's move on. We're also in silver as well, which is kind of a nice little hedge actually against our dollar yen position. And we did this based on the close of last week as an inside bullish bar, inside the range of this enormous low test bar 2 weeks ago. Unfortunately, it was such a big bar. We would otherwise have taken it, but it was so big in its range, we didn't, because we'd had to have had our entry above the high, stop loss below the low, and we'd have to wait many moons for us to even make a 1-to-1. And there's nothing interesting or fun about that. So we thought, okay, we've got the next bar here, which is an inside buyer bar. That's fine, because what happened then is it correlated with also a bullish reversal pattern on the 4-hourly. There we go, double bottom. Let me zoom in, because at the time of taking the trade, our entry was above the high of the inside bar in the weekly, which correlated very nicely, thank you very much, with the break of the neckline of this bullish reversal pattern. And the great thing about using these kind of reversal patterns on the smaller time frames to confirm a move in the bigger time frame or a setup on the bigger time frame is we're only triggered into the trade if they've been confirmed, if the neckline is broken off the double top, double bottom, head and shoulders or inverse head and shoulders pattern. That is what's so powerful about it, in my opinion. Okay, so that is silver. So we're currently in those trades. We're also in dollar NOK as well. And we're selling this one based on, again, this is all or nothing outcome. Let's look at the weekly first. So a number of our clients, what they did was, given that this is a well-established range here, it made sense. Let's just rewind the clock a bit, sorry. Just look at this. Imagine the market is here now. We've got a decent range. We've got multiple tests and good rejections of these levels. 1, 2 on the level of resistance, 1, 2 on the level of support. So based on the fact that we're looking for clues as technical analysts, and we're anticipating what's happened before could most likely happen again, unless we're just, unfortunate and the wrong side in opportunity flow in the strategies, kind of like while delivering wins and losses. What would do, people would trade our supply and demand power zone strategy, would have had their orders on this level here, stop loss above the point around about here, so we're sensible, not too aggressive, not too close. Those people who would have wanted extra confirmation would have waited for bearish pin bar reversal off the top of this range here. Let's just move on. Let's just, wait for this simulator to hurry up. There we go. So there we go. We had bearish pin bar reversal. So a number of our clients wanted to wait for the bearish pin bar reversal instead of trading it on the level of resistance. That made sense. That was coupled with bearish reversal divergence as well, which is a powerful signal for us. So for the purpose of the strategy I've just taught you, we'll be entering just below the low here, stop loss above the high, and targeting the midpoint first target, the bottom of the range second target. So we had these instances where price just carried on keeping on going down. Dollar NOK, I know in the moment it does feel like an eternity if you're trimmed the weekly time frame and you waited, say, 3 weeks for a profit and then you're break even again. But remember, this is why it's so good not to look at the chart, because had you waited patiently for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 weeks, that's an easy 1, 2, 3, 4, 5, 6% profit if you trade the break of the low of this bearish pin bar reversal. And that's good. All you need is a few of these every year to really kind of get a respectable return. Those people who trade on the horizontal level, they would have been making something very similar in terms of 6%. A number of our clients actually took both setups. And that's absolutely fine, because they were at the point where they put their order to sell on this horizontal level, and as soon as they had their bearish pin bar reversal close, they moved their stop loss on their original trade from here to the top of the bearish pin bar reversal, so they had a free trade there. The worst that could have happened to trade one was break even if the market came back. It didn't, and then they had this second setup, so they could have essentially a free trade on this, and then their next trade, which was the break of the low of this bearish pin bar reversal here. So they essentially doubled up in terms of not the risk but the reward. So it made a very easy 12% with this ride down, and this was generally kind of like people waited 10 weeks for this, but who cares? Okay, there is a disproportionate relationship in trading with time to what is essentially gained from it. Okay, so we're looking very close at the bottom of this now, and waiting for longs. I mean, remember that people who've traded both these setups here have made 12%. Even if they buy at the bottom of this range here and it crashes through, not only will that be the end of it will be quite a meaningful development, given that this range has held ever since 2015. It will also mean a small loss. But you know the old expression, you do have to be in it to win it. And if you've made money on the way down, it makes sense to anticipate making money on the way up. You need to ask yourself, what is the worst possible thing that can happen if I take this trade, i.e. you make a decent return on the way up, versus what is the worst possible thing that can happen if I don't take this trade, i.e. you miss out on potential upside out of no reason other than fear. Okay, so it's moving on. I'm just going to, I know I've got questions coming up and I'll be delighted to answer them, but I just want to talk to you about an exclusive running today, today only with London Investment Week. And you've taken the time out of your busy days, and I want to reward you for making the effort. So what we're going to do is give you access, unfettered access to our unlimited program, which is CBT accredited valued at $1,997. We're going to give you access for 1 month of $30, and that will give you access to all of our market analysis, weekly and monthly, trade signals on the daily and weekly charts. You'll get access to all of our strategies, both basic and advanced, our kind of like tutorials in analyzing markets. We've even got pattern recognition software for you to have, as well as an audio hypnosis course for you. Essentially, it's no holds barred. You'll have access to anything and everything. We do not keep everything or anything back from you. Okay, so you'll have unfettered access to all the strategies, systems, and tutorials at this 88% discount. But it is only open until midnight tonight. To receive this, go to thelazytrader.com/forex training, or click on the link that Simon will give you in the chat box. Read the terms and conditions, buy the ultimate program, use the promo code round the clock. It's one word and it's in lowercase. Round the clock, hit apply, and that will generate your discount, changing 252 into 30. That is your present for coming on this webinar today. If you're not happy, we'll give you a refund. We're still waiting for the first person to do that, but it's entirely up to you. No love lost if you don't, but if you do come on board, we look forward to welcoming you with open arms. Okay? So if you have any questions, I know Simon has hinted that there are questions, then certainly we'll look to address them. Let's just go back to this.
Okay, Rob, thanks for that. Yeah, just one or two questions. First of all, going back almost to the start of the presentation, Amit said, what are the fundamentals? What are the key fundamentals of any stock that you pay most attention to?
Well, I'll look at interest rates, all right, because one thing I do want to be sure of is the positive and negative carry. I'll always look before I'm trading, say, the weekly time frame. Say I'm trading, say, for example, in Australia, the interest rate is 2%, or sorry, New Zealand, 2%, whereas in Japan, it's 0%. Say if I'm looking at for a setup which is, say, a New Zealand yen sell, I'll probably want to take that as a futures contract rather than a cash daily rolling position, because I know I'll be penalized every night where that position is open, and as I will be in that position for weeks, that doesn't make sense. So that's why I look at the fundamentals. That's the main thing at the moment. And obviously, if interest rates are increased in any country, then that's going to increase the level of investment to that country. If, say, for example, they increase the interest rate in United Kingdom, say tomorrow, say to 1 or 2%, then I'll bet you your bottom dollar that the value of the British pound versus any currency will shoot through the roof. Okay, so whenever you get these interest rate decisions, and there is a big change in interest rates, even if they're by surprise, a surprise revision of interest rate by the central banks, then I look at them with interest. Okay, so that's the main thing I look at. Non-farm payroll day, I know that's considered to be the most important release in the calendar every month, but honestly, I don't give it a second look, quite frankly. When people ask me about it and say, hey, Rob, it's non-farm payroll today, what are you doing? I'm like, well, I'm actually going for a swim. What are you doing? So, but yeah, I hope that answers the question.
Okay. Richard's asking, he says the $30 offer per month, is that a $30 going forward, or is it just for that 1 month? Is it a trial?
It's a trial. So basically you get access to everything for that $30. The enrollment fee is normally $252. There is a subscription afterwards of $160 per month, where you'll get access to the forums, the mentors, the strategies, the learning materials, everything, no holds barred. You can cancel at any time, providing you give us 7 days notice, and there's no minimum term contract. It's all very straightforward.
Okay, thank you very much. Oh, thank you, says Richard. Great. I'm a new trader in South Africa. Yes, I'm not sure this is a question relating to this particular presentation, but Moira says, I'm a new trader in South Africa. We're using the currency US dollars to trade. News: no mining license sold. expecting Rand value to fall. I think I've gone back to Moira already and said I'm not sure this is a question we can answer particularly. Moira, if you're there, if you want to maybe rephrase that question, it's just a little bit difficult for us to understand exactly what it is that you're asking there. But essentially, the dollar being the dominant currency there is an obvious factor.
Well, I think the South African rand, I mean, I'm very well aware of the political turmoil going on in South Africa with the kind of autocratic decrees passed by President Zuma and the incumbent ANC. And okay, you can reason. Well, my prediction is that, you know, given that South Africa has been kind of relegated to junk status, and we can only expect the US dollar to strengthen into posterity. I mean, South Africa is economically, it's a basket case. It's such a pity. It really is, economically speaking, the mismanagement of the government there, and the ineptitude and immaturity shown by the ruling party is absolutely incredible. So I can only expect the rand to weaken. Well, indefinitely, until further notice, until someone else gets into power, like the DA. But I mean, the rand is closely linked to gold as well, so that is a bit of a help from spiraling decline.
Indeed. Okay, just a few minutes left. Any other questions for Rob, particularly before we cross over? No. Okay, I think we're probably okay there, Rob. So just that link is in the chat box. If you want to go ahead and take up that $30 trial, please do so. Rob will be back in touch with you to make sure you get all that set up. But I think we'll leave it there. So Rob Colville, the Lazy Trader, thank you very much. Again, always a pleasure to have you on. Thank you for giving us all the benefit of your insights, and I'll take the presenter role back from you until the next time.
Simon, thank you very much indeed for allowing me on. It's always a pleasure to be on these round the clock traders, and I wish you every success for the rest of the day.